Good afternoon, Quasar Markets Live. I'm excited. I haven't seen Kevin in a while. I was in New York. Kevin Green, Schwab Network. A lot is going on in the markets. People are so nervous. The world is falling. Chicken Little's running around without an army helmet. And is the world falling apart? Are we done here? What's going on, man?
Look, I mean, we are seeing a breakdown in the markets. I think the market is not only concerned about the lack of potential rate cuts, especially when you're looking at the December Fed meeting, as well as some of this artificial intelligence narrative is taking a little bit of a hold here. Maybe not so much for the mega cap names outside of, let's say, Oracle, but when you're starting to look under the hood on the private credit markets, you are starting to see maybe some fractures within that market, which is also creating a little bit of volatility. And then this week, Stephen, we have VIX expiration, which is going to take place on Wednesday. Last day of trading those VIX options is going to be tomorrow. That can create a little bit of excess volatility within the vol of vol space if you're looking at VVIX. And then we have the monthly expiration on Friday. So there's enough that's on the plate to create a little bit of churn in the market. And unfortunately, and we also have crypto, but unfortunately, we need to pick it back up here in the next couple of trading sessions because we're starting to see a lot of sectors starting to hinge and turn and roll over here. And I get a little concerned that if that does occur, this could get a little bit deeper when it comes to the downside for the S&P.
All right, so about 40,000 times today, I was asked about what the Fed's going to do come December. I was like, look, I don't even know. I don't even know I'm going to have a breakfast. How the hell do I know what the Fed's going to do? They're going to cut rates, right?
I think you're still going to see a rate cut by December, but I think you are going to see a significant amount of dissents, probably the biggest, the highest amount of dissents that we probably have seen in a very long time. If you kind of look at some of the commentary from last week, you could probably pencil in about 4 Fed members, voting members, are saying that they want to hold right now. We already know where Stephen Myron is. Waller obviously came out today and pretty much said he's in for a cut. So we will see a little bit of a split. And I think the risk that the Fed runs right now, I'm not saying cutting rates in December is the right thing to do. You and I have had that conversation through and through. But the big risk that they have right now is that the economic data that they're going to get from the U.S. government is going to be so volatile, very murky, maybe not as reliable as we would like to see. And do they err on the side of caution when it comes to the economy in the event that we do start seeing some cracks in the labor market that's not truly reflected? Yes, we have the inflationary picture that's kind of staying a little bit elevated here, but I would not be surprised if you still see a 25 basis point rate cut in December and maybe they pause in January, which probably is going to be the right move. What do you think?
Yeah. So, you know what's interesting, and even on my own shows, I've been saying the same thing. Look, I've been calling for this pullback. So even on Schwab Network, I call for the pullback. You and I and anybody in the world could find bad news anywhere. China, Japan now, Taiwan, obviously, Russia, Ukraine, nat gas in Europe's falling apart, oil. I mean, it's the budget again. It's crazy, right? Kevin, can you find me any good stuff out there? Give me some good shoots. Tell me something that's good. People are really freaking out a bit.
Yeah, I think if you, and I hate saying K-shaped because everybody's jumping on that bandwagon here, but let's talk about the high income earners. The high income earners are still relatively strong here. So if you look at that basket of potential stocks that actually cater to them, they're still seeing some potential tailwinds there. Also, if you're looking at the credit card processors, so the Visa, MasterCards of the world, they're still seeing some pretty decent fundamentals on a year-over-year basis when it comes to consumer spending, not only here in the United States, but also internationally. So you are seeing a little bit more of a diverse business, especially on the international front, that is going to be a tailwind for Visa, MasterCard, those payment processors. We have to remind ourselves, even though they are in the financial space, they do not carry credit risk. So that's really kind of that sweet spot that a lot of traders and investors are trying to find right now. What areas are still seeing growth in this market, but actually have reduced risk when it comes to credit? Because I think credit is going to be the thing that kicks the leg out of this market here, like it does each and every time when we have any type of downturn. You can always cite certain events that create it, but at the end of the day, the sustained moves to the downside or the aggressive nature to the downside for a lot of those market cycles revolves around credit. And I think that's probably what you're seeing right now. If you look at the private credit names that are out there, KKR down about 4.5% today. Look at those regional banks down a little, down over 3.5% today as well. I think there's probably a canary that's in that coal mine. I don't know if we want to pull that onion back, though, unfortunately, to see.
No, come on. I mean, I asked you for something good. You give me something bad.
Oh, again. I gave you something. Yeah, well, I'm trying to well, here's the reason why that could be good in some respects. Once again, kind of going those payment processors, and they're not the only sector that's out there.
Yeah.
The reason why I say that is because if you're looking for a narrative of a secular trend or strength in this market, but you're also looking for what's going to cause others to flock to that same industry to push asset prices higher. That's all trading is at the end of it, especially if you're a momentum trader. And so that's why I kind of bring it up. Like, yes, that's a negative tailwind for some, but if you're looking at where do institutional investors at the end of the year, they only have 6 weeks right now to try to make their benchmark. 75% of them are not hitting their benchmark right now. Regardless of this pullback, Stephen, they have to deploy capital. And in times like this, there's only going to be a few areas of the market that's going to perform. And I think that creates a vector for a lot of institutions to try to trade those. You could also look at the performance of some of the value sectors. That was kind of the theme last week. Look at those dividend payers as well. People always forget about it. This is not a recommendation, but we always forget about on these pullbacks. We're trying to figure out, well, is this the bottom for NVIDIA? Is this the bottom for Oracle? Is this the bottom for Meta? It might be. But if you look at those dividend players, the low beta players that are out there, those that have very low exposure to whatever the S&P 500 does, you'd be surprised to see what money has been moving to over the last week and a half. And sometimes in these pullbacks, you also get those, some pretty healthy dividend names that are out there that could actually catch a pretty decent bid or be a part of a longer term portfolio.
So over the weekend, I asked the people, what are you looking for in the markets? What do you want in the markets? And they all said the same thing. They just want residuals. They want some money, and there isn't any money to pull out of the market, right? So the only way to get money out of the market now is cash. And when I look at the few places to do that is oil and energy, and a few places like that would be real estate. Those two markets are dead. They're done. They're having problems, right? But if I look at commodities, you've got a big name that I think that you want to talk about. And I like this name. Let's talk about it. Soybeans. Talk about soybeans for me here, Kevin.
Yeah, so you are seeing soybeans. I'm sorry, utilities are another sector that's low beta. I have to call that out, and then I'll
Let's go.
I had to call it out, though, because that is a sector. The traditional utility names are actually still performing pretty well. Duke up 2% today. NextEra up 2%. Soybeans is a very interesting market. Here's the reason why I have my eye out on this. It's not so much the strength that you are seeing to the upside. You can look at the technical setup over the last couple of weeks. Obviously, it's been in a consolidation pattern. It started to see a little bit of a breakout, let's say at the end of October, and you are seeing a follow through right now. Now, if you're looking at the inventory levels for soybeans, or pretty much any grain for that matter, they're at actually elevated levels because we're not really trading them with China in particular when you're looking at the soybean market. But you are seeing some buyers really stepping in on the optimism that China is going to fulfill this commitment when it comes to these orders that Scott Besson is saying that they committed to. China has not actually confirmed these commitments, but we are seeing China buy some soybeans here. Now, the reason why I actually am keeping my eye out on this one, Stephen, though, is Trump 1.0 soybeans was the leading indicator. Once we started seeing China actually starting to buy a little bit, then we started seeing a lot of these other fulfillments from China when it comes to other areas of the market. And that's what you're trying to look for right now. Are you looking to see, is China committing to buying soybeans? Are we seeing a little bit of an easing when it comes to rare earth exports? Are you seeing us reciprocate with technology access in the markets? We are not seeing that yet. And if you're looking at the soybean purchases right now, China's only bought like two or three cargoes right now. They've only fulfilled 332,000 metric tons of the beans. They are supposed to be trying to hit 12 million metric tons in the next 6 weeks. So here's the reason why I'm looking out for soybeans. Do they commit? Because now each and every week they have to basically buy around 1.95 million metric tons in order to hit that target. Is it doable? It is. You're a grain trader. Is it doable? Theoretically it is. Is it Is it going to actually happen? Probably not, but theoretically it is.
Yeah.
So do we see an aggressive buy going from China into the soybean markets to push that higher? If that is going to be the case, I think that you get some more optimism on the China trade. And if we do not, and we see a breakdown, does the commentary out of the White House get a little bit more aggressive? And that's your risk off signal as well. So I'm using soybeans as a risk on, risk off indicator for the equity markets, not only just looking at the grain trade as a whole, which is obviously, once again, consolidating, breaking out, trying to make new highs.
Yeah, but if you talk about China, I can't believe I'm actually saying this, but now you got to talk about Japan, because Japan, the prime minister, the new prime minister, she said that she was sided in one comment. She's siding with Taiwan, and now China is starting to send their navy into the Sea of Japan and a few places around there. All of a sudden, China and Japan become an issue. Is China going to take their ball off the soybeans? Are they going to? They have a new boogeyman over there too as well? China, and then of course Russia is about to get new sanctions. So does China and Russia being? It's just starting to get a little wacky over there, I think, right?
Yeah, it's getting murky. I mean, 2026, I can tell you, the geopolitical front probably will not ease. It probably will get more and more complicated. And I know you're asking about Japan, and we could have that conversation. I think the United States is going to support Japan regardless. Why is that? Because Japan holds a significant amount of our treasuries. Yes. They're the ones that provide us the cash so we can do what we do, and then we provide them the backstop for them to do what they do. So there's kind of a mutual agreement that is there that has been working out a lot better for us than has for Japan over the last 20 years or so. But at the end of the day, that's kind of how that works. But I think you are seeing this readjustment or shift within the geopolitical front here. Now, how much is that going to have an impact on equity markets? I'm not too sure, especially on the Japan front. They have their own defenses. They can pretty much hold their own in some respects there. I still get a little bit more concerned about Russia, Ukraine, Stephen, because Ukraine now has a new Tomahawk missile. We've seen it in action. It hit the biggest port that's out there, impacting 2.2 million barrels per day. And Let me just say, once it gets middle of January and it's really cold in Russia and Ukraine, let's say they do hit a well, or they do hit a refinery, or they do hit an export facility, it's not only just can they get the materials to build it back up. If that oil freezes, which it does in Russia, that oil freezing could actually permanently impact their export abilities, and also permanently impact their pipeline facilities as well. So that's actually a bigger risk on the oil front that I think you could look at. I mean, oil is not looking that great from a demand side standpoint. Supply is healthy for right now, but that geopolitical risk of Russia getting impacted over the winter months and a freezing occurring during that same time frame, I think that's where you start seeing the byproducts like gasoline and heating oil, or diesel, what we call it, actually re-rating to the upside. And gasoline inventories for the U.S. is very low. We're below the 5-year average right now.
Very low.
So that's the big risk for me.
Are you worried about crack spread at all here?
Yeah, you are seeing a deterioration in crack spreads, and that's normal. I mean, you did see obviously this outside move to the upside when you're looking at the 3-2-1 crack spread. The thing about that, if that scenario does actually happen, let's say it does happen, right? That crack spread's going to blow out to the upside, right? Because you're going to see the byproducts are basically going to re-rate aggressively higher, more than what you're seeing for, let's say, crude oil or Brent, for that matter. So I don't think that's a tomorrow risk. Maybe not even when you're looking at first week, second week of December. But once you start getting into, the start of January, second, third week of January, that's where, especially in the northern front in Russia, where you could actually have a lot of those wells can freeze up really quickly.
Yeah, and before I pick this next thing, you're absolutely right. And one of the things I saw this morning was of nat gas in Europe, they're only at 80%, and it's not even cold up there yet, right? Some countries are at 60% and 40% in Ukraine of needing nat gas. So it's a massive problem. I agree. All right, I'm gonna get right to it. I want to add to the stage just this. I saw this morning, and Richard Moore, who's the former chief of MI6, said, "I have never seen the world as messy as it is now." This isn't just some MI6 person or member. It's the former chief of MI6. Says the world is now messier than he's ever seen it, and he's retired. He's out. The messiest he's ever seen. That's a problem, Kevin.
Yeah, and it's going to continue to get messier. Look, we're not going to have one day. It's not like 5 years from now we're going to be like, whoo, thank God we don't have any problems. We're always going to have problems. Like, right? That's
I
always
agree.
going to be it.
But to say that the world's is the messiest he's ever seen, which puts it in 4 decades, that's a long time.
It is. It is. And you're starting to see, I mean, for you history buffs out there, what is it? Every 150 years or so, you usually see a reshuffling of alliances and reshuffling of powers for the most part, right? World War One. I don't say we were best friends with the Russians or Soviet Union at that point in time, right? We weren't great, but we all also had a common enemy. And then you look at, World War II, and then now we had the Cold War. I mean, there's a lot of this stuff that kind of shifts. So you are just seeing a balance of power being readjusted here. And I think we'll be able to get through it. I think if you're a commodity trader in that type of environment, though, that's where you have the fuel for the fire of a commodity cycle in those type of environments. I don't think we're there yet, but I think that if you like the commodity space, I hate saying it like this, but you also then like geopolitical risks. Because that puts a little bit of an extra edge on volatility in that type of scenario here. And if you're an equity trader, if the world's gonna end, what do you do? Right? If the world ends, what do? You buy. I mean, like that's
you're buying guns and ammo, and
you can't take it with you. I mean,
are you a prepper, Kevin? I like this, man. I like this. It's good.
I am. Yeah. I mean, I do prep. Yeah, but I'm just saying, like, that's how the market treats these events as well, right? Anytime that we have something that occurs, yes, the initial reaction is usually lower, but that's when you start seeing, especially institutions on the sidelines saying, okay, here's my time to actually, put some dollars to work. And it's unfortunate when you see those type of events from Pearl Harbor to a 9/11 to you name it. Those are all really bad events. And you did see aggressive selling in the equity markets or in the gold markets, but people go and try to buy those type of events. So it's unfortunate, but it does provide some opportunities in the long term here. I'm not sure if that's where I think we have more near-term risk on economic data, as well as Fed policy pretty much up until about March. And then I think Fed policy after March, April, I think the writing is going to be on the wall there, what we're going to be doing for next year.
Yeah, I agree.
And I think it's okay to take have this pullback here. I don't know what's happening with crypto. That's the only one. I mean, Bitcoin looks like somebody's getting margin called, more than just one person. Let's just say.
Oh, are you just going to say Michael Saylor? Are you?
I'm not saying anybody. I'm not going to say any names out there. But all I am saying is that, Stephen, when you see these charts, distribution. These are classic distribution charts here. This is any type of selling into strength. I mean, any strength, any small sign of a bounce, you're seeing 2x, 3x the volume hitting those bids as aggressively as possible. And this is actually a really good technical lesson for a lot of traders. If you want to see what a distribution looks like, if you want to see a complete meltdown, you can look at Bitcoin right now. The technical setup is pretty much right there. Oracle is another one that's a really good example of a distribution. Sometimes you can see stocks and they start to hold a certain support level and you're like, okay, I can take a shot. But you are seeing completely selling into strength. Now, I can tell you probably 6 months from now, we'll probably hit all-time highs. Some crypto bro is going to reach out to me and said, look at how bearish you were on Bitcoin, because they all buy exactly at the bottom and they sell exactly at the top. But I am saying that this is a risk-off tone that is taking place here, and it's having a little bit more of an impact on the equity market than I would have expected. And we'll see where the bottom is. But the technical levels right now kind of point towards 82 and a half. What do you think?
I see what you're talking about. There's 75 and there's 82. I totally get that. And I've heard that a few times. I do think that this is where we are. I think capitulation has happened. I'm a little concerned. I totally agree with you on the slap in the bid. I don't like this bid slap that they're happening. For those of you out there who don't know what I'm talking about, that means that every time someone buys, someone as Kevin was just saying, that they're 2xing and 3xing, and I think they're actually 50 and 100xing it, to be honest with you. That this is where capitulation happened. If I pull up a weekly chart of Bitcoin, this is why I think we might be slowing it down, right? Is at the bottoms here, and that's why That's why I think we passed that up. So I know that everybody's saying death crosses and cross and this cross, and I mean, look, Kevin, you and I have been in this game long enough. We know all the adages and we know all the technical indicators. To me, I think this goes beyond technical indicators. I think this is just people needing money, cash. Yeah. And I think
can I say something real quick?
Yeah, of
if
course.
You look at those death crosses, what you're talking about, what is it? The 50 EMA or 50 SMA, 200 SMA.
15, 200, yeah.
Yeah, that's usually the most popular one. If you actually look at it from an equity standpoint, or look at the S&P 500, the NASDAQ, or what have you, usually what we have seen lately is those death crosses, they are bearish, but it usually occurs 75% of the way down to finding a bottom. It's not usually that's when the acceleration of selling happens. So anytime that I see death crosses right now on charts, I feel like, just based on my observation, that means that we're kind of closer to the end. I'm not saying we're 90% of the way there, right? But we are closer to the end than it is the beginning. And usually when you kind of map that out with weekly charts and things of that nature, it kind of adds up that way. Now, Bitcoin, once again, I stay in my lane. I think we've had this conversation. I look at the charts themselves. I look at distribution, but I stay in my lane. So it doesn't look good to me. Let's say in the monthly chart.
Look good. Okay. All right. I like that. All right, everybody. Kevin Green, my friend at Schwab Network. We all appreciate Schwab and our partnership here, Quasar Markets. And Kevin, I'll see you right back here next week, my man.
Appreciate you, boss. Have a good one.
Later.